Arista Networks stock has been soaring in the last year as the company's networking equipment and services for data centers optimized for artificial intelligence is creating a surge in demand. Analysts on Wall Street are bullish on this company's growth prospects, given that the data centers optimized for AI are going to continue adding billions of dollars of new facilities. So, understandably, investors are curious what's a fair price to pay for Arista Networks stock? I'll answer that question in this video, and I'll share with you how I arrived at this calculation so you can see for yourself and make adjustments yourself to the figures that I've utilized.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So my intrinsic value calculation for Arista Networks has the stock valued at $71 a share. $71 or around $70 per share is what I have calculated as a fair price to pay for Arista Networks stock. And just to give you a comparison, the current share price is $109. So according to my calculation, it does look overvalued. But let me share with you how I arrived at this number so you can see for yourself if some of the numbers I used were too low or too high, or if you think there needs to be adjustments, whatever the case might be. So let me start by sharing the free cash flow forecast. According to Wall Street analysts, they believe that the company's free cash flow will grow from $3 billion in 2024 all the way up to $4.76 billion in 2028. From 2028 to 2034, I'm forecasting that its free cash flow will grow to $7.04 billion, up from $4.76 billion. From 2035 onward, the long-term growth rate I've utilized for Arista Networks is 5%. So the terminal value calculation in 2034 comes to $135 billion. When I get the present value of all of these cash flows expected in the future, it totals roughly $80 billion. The discount rate I used for Arista Networks is 10.48%. I gave them a cost of debt of just 6%, a cost of equity of 11%, and I used a capital asset pricing model with a beta of 1.08, a risk-free rate of 4.5%, and a market risk premium of 6%. The company's market cap was $149 billion when I did this calculation, and it has zero debt. And since it has zero debt, I've given them a target capital structure of 10% debt and 90% equity. Sometimes even when companies have zero debt, I give them a target capital structure with higher expectations, because most businesses will eventually take on some debt, because if they continue growing and generating profits and cash flow and they still have zero debt, they can borrow at very low interest rates. And so they'll capitalize on that as they grow to borrow, even if they don't need it, right? You've seen a large company like Meta Platforms, which has a pristine balance sheet, didn't need to borrow any money. But in the last year and a half, they borrowed $10-20 billion because they saw that as opportunistic. They saw a very low interest rate and they took advantage. Similarly, I expect companies like Arista Networks to capitalize on the very low interest rates that they can use because of their strong balance sheets, strong businesses that can attract lenders for low interest rates. So the value of operations were $80 billion. We can add the company's cash balance to this total, because when you buy a business, you get the business's cash balance as well. Subtract the debt, it has zero debt, and we arrive at a value of equity of $90.8 billion. And I divided by the number of shares outstanding of 1.281 billion. That gave me the intrinsic value of $71 per share, compared to the current market price of $109 per share. Since the company's beta is just 1.08, it's not the higher beta that's resulting in the lower intrinsic value per share. In this case, it's the free cash flows for the future are not valued as much as the current market price. So the market expects most likely that Arista Networks free cash flows will grow at a faster rate between 2028 and 2034. Maybe my forecast for Arista Networks at 6.75% growth rate between 2028 and 2034 is too low. Maybe the market thinks the growth rate is supposed to be faster, and that's why the market price is higher than my current intrinsic value per share calculation. Remember, these numbers shaded in green, I retrieved or were retrieved from ticker.com. And the numbers highlighted in blue here, like the beta and the market cap and the number of shares outstanding, were retrieved from Yahoo Finance. So my calculations suggest, even when I apply a margin of safety for Arista Networks, it suggests that according to this calculation, it's overvalued. But remember, I don't only use one metric to determine if a stock is a buy, hold, or a sell. This is one input in my overall 6-step framework for evaluating stocks. And valuation is 40% of my framework, right? So there are 6 steps in my framework, but I don't weigh each step equally. The valuation step, which is one of the 6 steps, I give a greater weight because valuation is so important in my mind. I can see the greatest business in the world, but if it's trading at a price that's too expensive, it makes a poor investment for me. So I weigh valuation at 40%. The discounted cash flow valuation is one of the 2 or 3 methods I usually implement when I'm looking at valuation. So just to give you an idea about how I look at evaluating a business, whether or not it's overvalued, fairly valued, or undervalued, and then how that plays into my decision of buying, holding, or selling, right? I don't only look at the numbers. It's one of the steps that I utilized. And I recommend everyone take a more comprehensive view when evaluating a business. You can't tell whether a business is a buy, hold, or a sell just by looking at the discounted cash flow numbers, at least not in my opinion. I think it takes more analysis to dig deeper in the company's prospects and the qualitative factors before you can determine if a stock is a buy, hold, or sell. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.